everybody, and welcome to Interactive Broker Sense of Security podcast. I'm Mary MacNamara, and today we are talking with Jose Torres, IB's senior economist, about the quadruple 4 data points that came out. And so he's going to talk about it, and we're going to hear it one by one. Thank you, Jose. Hope you're doing well.
Good morning, Mary. I'm doing excellent, and especially on Thursdays where we gear up and we record our weekly Sense of Securities podcast. Sense of Security, rather, not securities. So, quadruple beat this morning, September 25th. GDP, second quarter, upgraded to 3.8%, folks. That is the fastest rate of growth in 7 quarters since the third quarter of 2023. So the economy is accelerating. We're seeing growth. Way better than expectations. That was a revision, but way better than expectations. Then we got a durable goods report, up 2.9% month over month, something like that. Expectations were way below that.
Refrigerators and things like that, right? The best
factory equipment, automobiles. What really drives this report, though, Mary, is the aircraft, because they're so expensive, so it moves the needle so much. And what happened last month in August was that you had not just passenger aircraft, which are mainly Boeing. You had passenger aircrafts do really well, but you also had defense aircrafts. Passenger, which are typical JetBlue kind of aircraft, Delta, American, where folks go to the airports and get on those kinds of airplanes. And then you have the defense airplanes, which are more geared for military use. But from an economics perspective, we tend to look more at the passenger jet category because, of course, that's more indicative of where the economy is, where military cycles are more influenced by geopolitical conditions and stuff like that. But durable goods, Mary, came in at 2.9% month over month. The consensus was expecting a 0.5% contraction. Yeah, so that was a big beat. But the best thing in that report was the second consecutive month of really strong business investment, capital expenditures. And that's great news. The current administration is really focused on onshoring manufacturing production and getting firms to invest in heavy equipment and factories and semiconductor production facilities, etc. So we're seeing evidence through the numbers that activity is buoyant. However, the manufacturing sector still struggles from an employment perspective. It's lost jobs this year, and also from an ordering perspective. This report was good. But overall, the last few years, manufacturing orders have been really sluggish, and that's really, Mary, because of high interest rates. Consumers aren't really making those purchases as much, and businesses as well, because when financing costs are that high, it constrains the volumes that can be sold.
What about tariffs? Didn't that affect things, or no?
Tariffs, yeah, they're definitely a reason why. Of course, there's a risk that you're going to have tariff-fueled price pressures in the future. We haven't seen them yet. At the margins, not enough to move the inflation needle or the overall outlook on price pressures. But we're beginning to see that firms, to avoid the tariffs, they're trying incrementally doing business here. But these are slower moving factors. We have to wait over time, see what happens. Factories aren't built in a day. Neither was Rome. And it takes time. The other 2 data points were initial unemployment claims, general unemployment claims, both the initial segment, which is essentially how many people were laid off, and then the continuing claims segment, which is how many people are still collecting unemployment claims because they couldn't find work. Both of those metrics went down. Initial claims came in at 218,000. The expectation was 235,000, so big miss. 2 weeks ago, the week of Labor Day, sometimes holiday shortened weeks are very volatile and they could have very noisy data. We had a scare. This is roughly 2 weeks ago, number came out, 263,000. So that was the highest in 47 months. Yeah, so that was a scare, and markets were really worried about that. Wow, layoffs are really spiking. Is this just a blip? Or is it going to be a continuation? For now, Mary, thank God, it's just been a blip. We haven't seen a continuation in that. Yesterday, we got the highest the fastest pace of new home sales in 43 months. That was a really impressive number. That's starting to add to evidence that plunging mortgage yields, mortgage rates have been coming down a lot. That motivates residential activity, transactions. That's the beginning of some evidence that those lighter yields, lighter rates are bringing buyers in. But then this morning, that was yesterday on September 24th. This morning on September 25th, we got existing home sales data. It was a beat. It came in at 4 million seasonally adjusted annualized units. So that means that over the course of 12 months at this pace, 4 million existing homes will be sold. That was higher than the 3.96 million expectation, but that's an August number. That was lower than July's 4.01 million. So we're seeing a little bifurcation. New home sales, big recovery, existing home sales flat. The former report, new home sales, is a government report. Folks have been talking a lot about government data and its quality. That's been a theme lately. And then, of course, the existing home sales report, that's from a private sector organization. That's from the National Association of Realtors. So telling a different story there. And then finally, this is not a huge, not part of the quadruple B. The quadruple B is GDP, durable goods, unemployment claims, and existing home sales. But the trade deficit also narrowed more than expected. So that was good news for the whole onshoring theme and producing more things onshore rather than relying so much on imports.
You mentioned capital expenditures, right?
From an economic data perspective, you find the capital expenditures on the monthly basis. You find it in the durable goods report in the area where it says capital goods, excluding defense and excluding aircraft.
You can't correlate like the CapEx for a company and the durable goods capital expenditures.
Theoretically, they should add up to the same exact number if we were able to isolate that the cap expenditures were all made in the US and all that stuff. So there is definitely a relationship, there's no doubt. In fact, it's not a dumb question because you know how many people forecast a durable goods report, particularly the airplane section, with what Boeing is saying, because Boeing is the only domestic airplane manufacturer. It's an oligopoly, it's them and Airbus for the most part.
About like a Gulfstream or some of the other private like jet companies?
These are manufacturers of jets or operators?
Oh, Gulfstream?
Yeah, they actually, so I'm not an airplane
Oh
expert.
my God, I know something you don't know. Okay, so Gulfstream, they produce jets, whole fleet of planes, the corporate jets, or the family private office movie star jets. I wonder if
Got it.
they're included in the durable goods too, or is it just like the big airlines?
Oh, no, they would be included because these are macroeconomic statistics, so everyone's included really. But just the only thing would be like, are they actually like manufacturing the jet itself? It sounds like they are. So then yes,
They are.
yeah, they would count. The market overall is weak. But as economists, what we do is we look for turning points. Oh, is this the bottom? Oh, mortgage rates are down. Home sales just shot up. Are we about to get a real cyclical recovery in the real estate sector? Looking for follow through today from existing home sales. Didn't get it. It's okay. Home builders, the good news is that those firms, they became a lot more disciplined after the 2008 financial crisis. So they don't add supply until they're sure that they're going to be able to move it. And once they see some softness, they immediately pull back and they stop building, they stop their capex and stuff. So that's the good news. They're good from a discipline
I'm glad
perspective.
everyone learned something from that whole experience. Do they ever break out how it's going for the Gen Z and millennials? Do they ever do a trend like that? Like how many boomers are selling? How are the Gen Zs and millennials changing the housing game? Are there any stats about that? That would be interesting to see if that is moving for that generation.
Yeah, they're not as fast moving. There's always research studies on demographics and talking about the home ownership rate and how many renters are there versus how many people that own their homes outright or with mortgages attached. There's all kinds of research studies that do that.
Where do you find
Um,
those? On the Bureau of Labor Statistics or other places?
the Bureau of Labor Statistics, no, probably the Census Bureau, I know is going to have a lot. So where you get the new home sales report, they actually publish the home ownership rate which tells you is America becoming more owners or more renters. A lower number mean that we're more relying on renters and landlords to facilitate our housing, whereas a higher rate would indicate that we are more independent in our housing quest and in the resources that we have associated with our shelter. There's mixed opinions. Some people want that number to be higher, like me, and then there's other people that, that think that renting is fine and they don't mind a lower home ownership rate.
It's interesting because the other night I was listening to a podcast and all of a sudden an ad came on about having trouble with realtors, can't sell your home, we'll buy it for cash. You don't have to do anything within 2 weeks, on and on. And I'm like, okay, is this the private equity people who are doing this? How does that affect everything? I know you've probably heard those ads too.
Yeah, you got to be really careful because a lot of times in the beginning it sounds great, and then once you start talking about fees and costs and share of gains or whatever, a share of transactions, then all of a sudden folks may not be as happy. Usually, you see a lot of those ads when there's lack of liquidity in the market and folks want to come in and maybe take advantage a little bit and play with terms that are super advantageous to them, but maybe not as advantageous to the folks that maybe need the liquidity. Maybe they're late on their mortgage. Maybe they need to sell a house fast in an environment where there's not that many buyers. So it's important to be prudent, to go nice and slow, to seek legal advice, to talk to people that you trust that have been around you for a long time, that have experience in the space, and they can better guide you as to what the best decisions are. Sometimes when you can't pay your bills, renting your own house and going to live with a family member while you get back on your feet, that's not a terrible thing either. A lot of times you can rent a house to someone else and that'll pay most of your costs. Or if it doesn't pay all of it, maybe it'll pay 80% or 75%. And that's enough for you to at least maybe take a little break and maybe move to a lower cost area or maybe move in with family members or something like that. You don't have to sell if you can't pay the bills at the.
Be careful with those ads.
One more thing on the housing, work with your lenders. If you can't pay, tell them, hey, look, give me 12 months off. A lot of times they'll do a workaround. They'll add your interest that year that you're not paying, but they'll just make your loan if you have 25 left. They'll just make you have 26 left. They'll do a workaround or something like that.
Yeah,
Talk to your lender, work with
that's
your
really
lender.
good.
What's happening Monday? We're getting closer to the potential for a government shutdown. IBKR forecast trader, our prediction market here, 60% odds of a government shutdown. Republicans and Democrats don't want to work together. President Trump is upset. The Democrats want to pare back the cuts to Medicaid. They want some of the health care insurance subsidies. They want those to come back in some form as well. And that's a sticking point for both parties. So we're going to wait. And if you pull up our forecast trader and you go press mark government fiscal policy, you'll see it right at the top. And I said 60%, folks, but these are live. It's up to 65% right now. So it's 65%. So 2/3 odds that we have a partial or full shutdown.
Wow.
By October 1st.
Okay, let's see what happens. I'm sure it'll be an interesting weekend.
We have tomorrow, September 26th, we have the Fed's preferred inflation gauge, the PCE inflation report. Personal consumptions expenditures price index. Why don't they use the consumer price index? Well, a long time ago, they decided to go away from the CPI and to go to the PCE. My opinion is that they did that because they could maintain lower rates with the PCE versus the CPI, because CPI is usually higher, about 43 to 45% or so of the index is comprised by shelter, and PCE cuts that in half. So if you're having a cost of living crisis and housing costs are increasing significantly, and you want to pick which inflation metric is going to reflect slower price pressures, you'd go with the PCE because it doesn't count as much housing. That's been a thing. And then that'll allow you to, as a central bank, to maintain lower interest rates because the CPI is going to be harder to get inflation to your 2% target as a central bank. It's all about the 2% target. Easier, the PCE is a lower bar to get there because housing isn't as much of a contributor. So we'll be talking about what the market reaction is. The markets have been in a little bit of a malaise lately. interest rates have started to go up, not for a terrible reason. The numbers are terrific. The economic data is great. And that's why rates are going up, because people are saying 3.8% growth. Wow, that's buoyant. Who's going to cut rates in that environment? And then you have an argument to cut rates as well, further or faster, was that the labor market was weakening. But today's unemployment claims were very mild, 218,000. Looks like things aren't that bad. Maybe we're already recovering because we got that rate cut. Because rate cuts, they motivate cyclical sectors. So let's see if real estate can turn around. Let's see if manufacturing can turn around little by little. But yeah, excited to talk to you all Monday, and you, of course, Mary,
So it's
about
always good to
what's
talk to
going
you
on.
because I always feel so much better after I talk to you. It's like there's these silver linings in the clouds, and I appreciate your time. And enjoy the weekend. We won't worry too much about the government, and we'll come back on Monday.
Terrific. Great to see you all. Thanks, Mary.
Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Displayed outcome information is based on current market sentiment from ForecastEx LLC, an affiliate of IB LLC. Current market sentiment for contracts may be viewed at ForecastEx at forecasttrader.interactivebrokers.com/en/home.php. Note: real-time market sentiment updates are only active during exchange open trading hours. Updates to current market sentiment for overnight activity will be reflected at the open on the next trading day. This information is not intended by IBKR as an opinion or likelihood of a potential outcome. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastEx LLC. ForecastEx is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastEx forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastEx. Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Hong Kong Limited, and Interactive Brokers Singapore Pte. Ltd. Futures, event contracts, and forecast contracts are not suitable for all investors. Before trading these products, please read the CFTC Risk Disclosure. For a copy, visit our Warnings and Disclosures page.
This is commentary on economic, political, and/or market conditions within the meaning of CFTC Regulation 1.71 and is not meant to provide sufficient information upon which to base a decision to enter into a derivatives transaction.